Today's video, I want to do a COVID market update and touch on inflation. What's going on with that inflation? Is it still transitory? Was it ever transitory? Let's get into it. The California housing market continues to have a lot to be optimistic about as home sales and mortgage applications stabilize and fundamentals like mortgage delinquencies are improving. However, when we look at the market holistically across the United States, mortgage delinquencies are up, so we need to keep an eye on that. Furthermore, California has kept a lid on the pandemic thus far into winter, which has helped to fuel a broader economic improvement as fewer workers enter onto the unemployment rolls right now. So there's a lot of jobs available, over 10 million. They're not being filled with supply chain issues as well. However, many ongoing challenges, including rising inflation, eroding consumer sentiment, and the likelihood of rising rates as we enter into 2022. So we need to keep an eye on that. That is worrisome. So further signs of stability in weekly sales, we can look at that. Although sales remain down on a year-to-year basis from elevated levels of last winter, they remain relatively robust compared to typical seasonal, retrenchment of previous years. In fact, California is beginning November with slightly more home sales than it saw during the first 2 weeks of October. And the October monthly data is likely to show a similar declaration after a strong summer performance. So, things kind of slow down a little bit during the winter here in the holiday season. Some of this information, this is encouraging because transactions are finding bottom roughly 5 to 10% above pre-crisis levels, even though they're down compared to, with 2020. So what are some signs of a strong winter in mortgage apps? New purchase mortgage applications also suggest that there is reason to be optimistic about holiday home sales, even though things are down a little bit. But some applications are creeping up. New applications fell last week for the 25th consecutive time, but the trend is losing momentum as the pace of decline has been in the single digits for the past 3 weeks in a row. So there's been a little bit of a change, an uptick. In addition, applications are not showing the typical winter declines that were evident in 2018 and 2019, indicating that winter home sales are likely to be well above pre-crisis levels, even in the pace of transactions dips from the heights reached last year. So residential delinquencies dipped below 4% in the state of California. Overall delinquencies are up across the United States. So for the first time since the onset of the crisis, the number of delinquency mortgages dipped below 4% of all loans during the third quarter. And according to data from the Mortgage Bankers Association, I also look at other things as well. Roughly 3.63% of Californians, that's about 5.2 million mortgages were delinquent last quarter. That is a 64%, roughly a basis point reduction from 4.27% last quarter, and a significant improvement from the peak of 6.83 during the second quarter of 2020. So importantly, delinquencies fell across every category, including serious delinquencies, 90 plus days past due, and it was the 5th consecutive quarterly decline in mortgage delinquencies in this state. So that looks promising for the state of California as far as the delinquencies go. When we look at the COVID cases, plateauing around 6K per day recently. So measuring by new cases and hospitalizations and deaths, the pandemic remains much improved from levels seen in the summer. The number of new cases has not been falling noticeably in recent weeks, but they have remained relatively stable at roughly 6,000 per day. Remember, 99.7% of the entire world population, including people aged over 70 or older, do not go to the hospital or die if they get COVID. So in addition to California has avoided another surge for longer than it did last year, when new cases were beginning to rise dramatically prior to the Thanksgiving holiday. This continued progress is likely contributing to the continued improvement in the unemployment claims that the state has been enjoying as well. We still have those 10 million jobs out there across the country and in the state. So small businesses are hurting. Rates starting to rise slightly right now. Interest rates, the Freddie Mac survey of mortgage rates actually showed a slight reduction in rates to just roughly under 3%, about 2.9%. However, daily readings on rates in the marketplace from Mortgage Daily News and Bank Rate indicate that rates have been rising modestly over the past week. Today, the reading is about 3.23%, and that has been leading Freddie Mac for the past few weeks. Rates will remain low by historical standards, but the intention of tapering by the Fed, which is going to happen in 2022, and ongoing concern about inflation intensifying, it's not transitory, folks. We have massive hyperinflation in the face of the latest CIP readings. The expectation is for mortgage rates to continue to inch up gradually going into 2022. So when we talk about the 800-pound gorilla, inflation and consumer sentiment cloud, the economic outlook right now, this is not transitory. I was talking about this a year ago. I saw the writing on the wall from the microeconomics. The macroeconomy got a 1-2 punch last week as inflation came in well ahead of the Fed target and even higher than the consensus forecast of the economists, and consumer sentiment, stumbled in the face of higher prices and elevated, numbers outside of California. So of particular note was the broad-based nature of the price hikes in the CPI. We talked about this before, which suggests that the latest bout of inflation is not isolated just to car and energy prices, but is affecting a much larger share of the consumer's typical bundle of goods and services. So I want to delve into the micro a little bit in regards to inflation. I've touched on this. A lot of people are touching on this, but it is very concerning. Hyperinflation. I think that they are actually, I think the government politicians actually believe that they could get away with it. I think they were actually convinced that they could just create, borrow, and spend trillions upon trillions of dollars without any serious long-term consequences. But they should have known better. They should have known better. The people running things are very highly educated people overall. Not all of them. They're highly educated. And after spending decades of, getting to their current positions of power, they're supposed to be experts, that we can trust with very difficult decisions. And unfortunately, the experts have put us on a path that leads to currency collapse and financial ruin. If you look at the history, if you look at the macro, if you look at the micro, all throughout history, there have been many governments that have given in to the temptation to create money at an exponential rate. And it has ended badly, ladies and gentlemen, every single time if you look at history and follow this stuff. So our leaders should have known better. So Game of Thrones, shame, shame, shame. They should walk the shame, be throwing tomatoes at them. But it is just so tempting. I get it, because pumping out money like crazy always seems to work out just great at first, and it does. For example, when you know, the Weimar Republic, first started wildly creating money, it created an economic boom. But we all know how that experiment turned out in the end. And when we talk about, this week, the mainstream media, the corporate media is full of talk about inflation. They're finally talking about it. And many of the talking heads seem mystified that things have gotten so bad, but anyone with half a brain, should have been able to see that this was coming. Just look at what has been happening to M2, and I've been talking about this since the start of the pandemic. Take a M2 is out of control. What we have been doing to the money supply is complete and utter lunacy, and this is inevitably going to kill the U.S. dollar eventually. you know that's where it's leading. Next, it's all over. Take a look at how rapidly the Fed balance sheet has been rising. This sort of thing that you would expect to see in a banana republic, and that's kind of how things are being run right now, is just throwing stuff at the wall. I think that our leaders deceive themselves into thinking that they could get away with creating money so recklessly, uh, but they haven't. They haven't. Very painful inflation is here. And on Wednesday, we have learned that prices have been rising at the fastest pace, ladies and gentlemen, in more than 30 years. 30 years inflation. Hyperinflation is here. And for the political pundits to say, well, you can handle it. We have a lot of money. You got equity in your house and this and that. This wasn't transitory back in the day. The writing was on the wall. And when you print, and you understand economics, it doesn't take a brain surgeon to know what's going to happen. We just flooded the market with printed money, printed more money, as I've talked about, at an incredible rate in the past year and a half. And all these spending bills, 5 trillion during COVID, and now another 2 trillion, and then maybe a reconciliation bill that the writing's on the wall with that is really 4 to 5 trillion. And we just can't keep doing that. We're going to have inflation. It's very concerning. Article just came out today about meat and poultry prices are going to go through the roof. Yes, the ultra wealthy don't have to worry about it. But like I've always said, the middle class, even the upper middle class, we have the Fortune 500 company that's the big motor, but the middle class is driving the car. Yes, I understand what some people are trying to do and wipe out the middle class, and more people get money at the top of the food chain. But the middle class is vital to the U.S. economy. But hey, as one high-level investment banker told me, Tim, we don't care if unemployment goes to 100%. We don't care because we got China, 1.5 billion people, and we can just keep printing money and have unlimited credit. Well, that's soon going to change. So the inflation is very concerning right now with prices across the board. But overall, when we talk about the COVID market update in the state of California from a housing perspective, things are looking pretty good and on an upward swing, and continuing in 2022. We'll have to keep an eye on the interest rates. Of course, we've been spoiled. We remember how high interest rates were in the 80s, and interest rates go over 4%. People have a heart attack. 4% still a low rate. So we've been spoiled. I just locked in a client outside the state of California in Las Vegas, and I got him 2.885 right now last week and locked it in. So, just got to know where to look and be creative like anything in life and think between the lines. So, all right, take care. Be creative, be kind, and read. Don't watch so much football. Take care.